We are back at the Big Money Big Daddy Show this Thursday afternoon. It is Investor Symposium week, so we hope everyone's having a good time. I know we are. We're learning a lot, so we look forward to sharing a lot of that information with you when we get back into Houston. So let's kind of pick up. We talked about in the first segment as far as kind of what's been going on in the markets and reacting to that. We gave some examples of even clients not staying disciplined when things happen in the market. And so we're going to pick back up and talk a little bit more about that. But before we jump into that, I just want to make sure, we were talking about, making sure that you keep yourself educated, about what's going on in the markets or just your investment philosophy and the right way to invest to make sure you're getting market rates returns long term. So if you want to get signed up for our next live coaching event, that's going to be August 18th at 6:30 in the evening at Papacitos. We'll be doing fajitas and margaritas. You can text the word daddy to 72727. Text the word daddy to 72727, and that will shoot you a link to where you can get registered for that event and also any future events that you'd like to attend. You can also call or text us during today's show with any questions or comments that you've got at 713-826-0426, 713-826-0426.
So when we talk about a lot of the hype and the things that have happened throughout the year and how, yes, there was, some shockwaves through the world markets and there was some panic and then everybody goes, oh, you know what, it's not the end of the world. And then things came back. And I don't know what, whoever's listening right now, what you may or may not have done, but there is a lesson to be learned. Even if you took the hype and made the decision and the accounts fell and then you got out because it was going to be the end of all financial markets, and then you realize that was a mistake. Don't look at it as a mistake. Look at it as a lesson to be learned. And that is, yes, take in the information. Yes, analyze the information. But don't get into or don't believe the hype, because it will cause you to do knee-jerk reactions, which are very dangerous for a long-term investor. And I'm willing to bet that even people that got out would have told me, at the beginning of this year, yes, I am a long-term investor. But we just continue to make those mistakes. So that's what Dale and I are on here today, is we're talking about, are you really going to be a long-term investor? Can you really invest in a way that in a way that's going to deliver good returns? Is that possible? Well, it's not going to be if you continue to do the strategies that most of the financial institutions push, and that is, put your money with our firm because we know the mutual funds to pick and which stocks to pick, and we know where the market's going, and we can tell you when to overweight and be in the market and when to underweight or be out of the market, and we can find the best money managers or hedge funds that are out there. All that sounds good, and I think that we have believed that hype. But when you look at the data, when you look at the fact that, Standard & Poor's comes out with their report every year, and it shows, depending on the year, somewhere between 20 to 30% of the top money managers in the world beat their market index. That means, folks, that 70 to 80% of the time you would have just been better off buying the market index. I mean, let that sink in. If you could go to Vegas and you could play a game that you won 70 to 80% of the time, what game are you playing? Now, are there ways you can do even better than just buying up the whole market? Sure there are. We talk about it on the show all the time. There are ways to add extra returns. We're going to get into that in the third segment on how you go about doing and adding those premium returns that, or making it more likely that you can add it, would be the appropriate way to say that. The thing is you cannot act on impulse when scary events happen. This is not new. Okay, scary things are going to continue to happen. In fact, when has the market ever been stable and secure? Well, now that's when everybody's going to be ready to invest in it, right? Yeah. It wouldn't give the returns that it has over time, which are very good, if there wasn't risk, if there wasn't craziness out there. Okay? Those who sell out of equities. Now, number one, you should decide how much money you should have in equities in the first place, what that appropriate amount is. And then whatever that amount is, yeah, you need to deploy those monies in the proper way. And then you don't want to just be moving in and out. I mean, we've seen, when you look over the last 90 years, Great Depression, World War II. I mean, think about this. This is crazy. In World War II, you think things are scary right now. Imagine if like 85% of industry was destroyed. I'm not talking Enron where there was like fraud and a collapse. I'm talking was actually blown up by bombs. Okay, I mean, it was literally destroyed. Did the markets recover? Did businesses find a way to make profits, new technologies, new goods, new services? Sure. Were markets down during those periods of time? Sure. In the short term. What happens long term? Yeah, we saw the Cold War, 9/11. Okay. I mean, we ran some numbers that I think that everybody would find interesting. If you just looked at a very simple mix of 50% of your money in the S&P 500, 50% in 5-year treasury notes, considered the safest investment in the world, then the number, if I look over the last 90 years and I look at 10-year time frames, there are 0 periods of which you had a negative return. And that's in 10 years.
Okay. 0, folks. 90 years, 0.
Yeah. When you had a 10-year time frame. Now, some of you out there listening, you say, I'm retired. I don't have a 10-year time frame. Unless you're planning on dying within the next 10 years, you got a 10-year time frame. Okay? I mean, that's the reality. The actual return, the average return was a little under 9% over that period of time, 8.69.
Past performance is no guarantee of future results.
Thank you, sir. So we got to throw in that. We always make sure. But I mean, I guess it's a struggle for us because the returns are out there for the taking and people are just getting such poor returns. And much of that is due to the advice that they're getting. It's due to what the media is out there saying. And that's sad.
Yeah. I actually I read an article the other day. It was in Forbes, and we talked about this back in May. We were kind of talking about sayings in the market, and one of them was sell in May and go away. And that's the typical where they say you can look at what the market's done historically, and usually there's a time period between May and October where the markets don't maybe perform as good. And they're talking about the S&P 500 in general. And so this particular article was actually talking about how the article was called Sell in May and Rotate. And so instead of them saying sell in May and go away, they were saying, well, sell, but then actually you should overweight in these 2 sectors. And so it was interesting to me that, they were stock picking. So they were talking to load up on, consumer staples and healthcare. And they went into talking about how they predicted healthcare was going to be over 6% rates of returns by the end of the year. So it was entertaining to me to read that article and see how people might read that, and they'll be like, oh, maybe I should do that. No different than I talked about the client we met with, that got rid of the international. He did it across the board, and so it's like, well, international was down, but it's like I start going through our scorecard, what we call it, and saying, well, did you realize, emerging markets were up, double digits, and you actually got rid of that? Was a smart move?
Was that part of your plan there, buddy?
Right. So it's like,
I'm sure you said it in a much more loving way.
I did. Yeah. So, but those are things that you just got to realize. I mean, you can't play the game. I mean, but it's easy to get caught up and pick up a magazine or read some type of article that make you like, oh, maybe I should implement that into my portfolio.
Yep. And it's done all too often, and it's frustrating for us to see it. I mean, we are out here to teach people the right way to do it. You know, our belief at Wealth Design Group is we want you to have an understanding of what you're doing and why. Because if you have a core understanding, no, you don't have to know everything that we spend 50 hours a week doing. But if you have a core understanding, the way that we work on that is we have what are called the 20 questions. We've gone through them on the radio show a few times, but they're 20 key investment questions that if you can answer in the affirmative, then you're going to have a core understanding of how to really invest for the long term, and you are going to be far, 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 far less likely to get those terrible Dalbar type returns. In fact, you're going to be far, 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 far more likely to get what the market returns have been. That's no guarantee. Just saying, we found that by teaching and educating, we're putting people in a much more powerful position, and that gives them confidence. That means we're achieving things with more certainty. That's what we're trying to do. Nothing is for sure, okay? But more certainty is good, and confidence is good. And we hope that by having those things at some point in time, you'll have some peace of mind. I mean, that's one of the hopes that we have. So, you know, just we don't know what, you know, the future's going to tell. I know, Dale, you just talked about, you know, people pulling out of international and they miss. I mean, you know, we saw this in the late 90s. I mean, it was the U.S. markets, especially the S&P 500, which, by the way, that was S&P 500 has been doing pretty good the last few years. Now, granted, we're talking single-digit low returns, but in comparison to everything else, it's actually been one of the better performers. And, you know, we saw this in the late 90s. Now, back then, it was in the double digits, but it was the top performer. I mean, everything else was also getting good returns, but S&P was the top performer, and people started to say, why international?
Right. I mean, you also, emerging markets, number one, are one of the most volatile, you know, asset classes out there. So, I mean, it was probably, a year or so ago where international emerging markets were actually down almost double digits, you know, and so people were wanting to get rid of them, where actually we're talking about going in and rebalancing, and you actually want to buy more while it's low. I know we haven't really talked about rebalancing during the show, but that's actually what you should be doing, you know, to take advantage of those opportunities when there's some type of correction in the market.
Yeah, I was just kind of pulling up this is a mid-year number. DFA emerging markets value is up over 10%.
Yeah.
And that, you know, which is crazy that people bailed on it and said, well, we'll just go with just the US. When I ask you, should you have a diversified portfolio, I don't run into too many people that say no. But then when I see the way that people act, they move away from it and they gravitate towards whatever just recently did good.
I mean, it's just human nature. I mean, you see red or negative, you know, or, you know, not good performance on your statements. When you look at it, you're not happy about it. So the instinct there is to get rid of what's doing bad and go load up on more what's doing good. And we see that all the time. And we had that, you know, 2 years ago when the S&P 500 was just the hottest thing out there, and people just wanted to sell everything else and load up on that. I mean, so there's always going to be something out there that's driving, you know, performance. You know, it's easy always to hindsight's easy, right? It's always say, oh, I should have loaded up on that because that was the hot thing this past year or this past quarter. But you can't react to what's already happened. The point of the matter is to understand how much volatility you can take inside the portfolio, which I think we're probably actually going to talk about that in the next segment.
Yep.
Is to define how much risk you're willing to take. And then once you know that, then designing the rest of the portfolio is pretty easy based off the math, science, and academics that we use to design the portfolios.
Yeah, you know, it's I think that's going to be great. I mean, we'll finish strong today with how to do exactly what you just talked about, Dale. We'll talk about how to get those extra premium returns that I mentioned as far as improving the performance of your portfolio, what gives you the best chance to accomplish that. And I think that that'll be a great way to finish out what's going on. But, you know, I want to make one comment. A diversified portfolio, by definition, should have some stuff that did better than other stuff in it. So you should see a broad range of returns if you're truly properly diversified. So I don't understand why all of a sudden you have a few areas that don't do good. If international's slightly down, that all of a sudden you want to throw that out and think that now you're making a prediction on one thing or another. Predictions are bad. We talk about this stuff and can show you what you should do. Come to our live coaching. Learn about our upcoming events. Just text the keyword daddy to 72727. Text daddy to 72727 or call us at 713-826-0426.
Big money, big daddy.